It's a crazy time that we're living in. Everybody knows, obviously, we in, the age of Corona. And I remember texting you, like, when Corona first hit, I'm like, yo, that's when the stock market was crashing.
Yeah.
And I'm like, yo, this real estate market about to crash. And you was like, nah, it's not. And I'm like, how? People losing their jobs, stock market's crashing, people can't go to work. Like, all the writings on the wall for another 2008 to happen. And you was like, nah, commercial real estate might be in trouble, but residential real estate, I'm like, all right, we'll see. Yeah. And then to this day, it hasn't crashed. It's actually gone up in most places in America. The home prices have actually gone up. It's a shortage of inventory on the marketplace.
Absolutely.
So where are we at right now as far as the state of real estate in the United States of America?
The market is on fire for residential, and I told you this back in March. I said, nah, bro, it's not going to happen, because what people and everybody was kind of saying the same thing. Like, yo, 2008 is coming back. Wait, don't buy, wait. And I said, 2008 was different. That was a credit crisis, right? This is a health crisis. Credit crisis means that banks, Wall Streeters, everybody, homeowners, investors, everybody was greedy, appraisers, everybody, right? So when the market crashed, the government was reluctant on trying to save everybody. They didn't want to bail out everybody, but they had no choice but to bail out the big names, right? So with this one, I said, now this is health. This has nothing to do with nobody. This is nobody's fault. And if you think about it, if you look at the real estate market going into 2020, it was already on fire. It was due for a correction at some point, because what goes up must come down, right? But I said, nah, this is not going to crash. There's no way, because the government is going to have to bail out everybody now, right? From the big businesses to the everyday person. And when you told me that it's going to crash, that's what was in my mind, because I knew, especially with an election year, they couldn't just let all these people die, people lose their homes. There's no way. And as you see, all these stimulus packages came out. Everybody getting their PPE money and everything.
It was reckless with it. Hopefully they wasn't reckless.
Hopefully they wasn't reckless, and hopefully they did the right thing. But, you have unemployment benefits. People are getting them with ease, with no problem. So, you got to give the administration credit for what they tried to do to help as many people as possible. And that's why I just didn't feel like the market was going to crash. But residential real estate is on fire right now all over the country. There's 30, 40 offers on one house, So if you're a seller right now, if you're thinking about selling your home to upgrade or downsize, this is the time for the sellers right now, because they're going to get 20, 30% above asking price in some markets right now, because it's just too hot right now. There's too many buyers out there. And with these low interest rates, with rates being in the mid 2s to low 3s, depending on your circumstance, like, everybody wants to buy a house because money is cheap now, right? So it's easy to the person who couldn't afford the $500,000 house last year when rates were 3.5%, 4%. Now it's 2.5.
Can you explain because the average person that maybe never bought a home might not fully appreciate, because they're saying 3.5, 2.5. Yeah, it's only 1%. That's not that big of a deal, but because they're looking at it like it's stocks, like it's like, all right, if you earn 1%, like, know what I'm saying, or just regular life, 1% doesn't move the needle. But in your world of mortgages, 1% is huge, right? So can you kind of put that in perspective for people?
Yeah, I mean, look, 1%, depending on your loan amount, right? That can be $300, $400, $500 a month. That could be $6,000, $8,000, $10,000 a year, depending on the size of your loan. Right. So the bigger the loan, the lower the rate, the cheaper the payment. Right. So someone, again, who couldn't afford the $500,000 home or get pre-approved for a $500,000 home a year ago, because the rate was probably 3.5 to 4%. Now they're able to, because now that brings their payment down, and they're able to get approved for now that higher amount. So 1% is huge in the real estate, in the mortgage world. Interest that you're going to pay over the life of the loan is also very important too. Because if you're looking at any house that you buy, let's face it, right? The way the mortgage and the banking system is set up, it's, you're going to pay interest 3 times more than what the house is actually worth. But if you're getting a cheaper interest rate, that softens the blow a little bit. And now you can focus on your debt strategy, which is repaying back your debt and trying to beat that interest trap. You know what I'm saying? Yeah. And little things you can do to do that. You can make one extra payment a year and you can pay off your loan in 22 and a half years if you have a 30-year mortgage. What I tell folks all the time, take your income taxes refunds, right? And apply that every single year to your principal balance. That could bring down your debt. You can do as little as $100 a month to your principal balance, and you'll be surprised of how much interest you'll save on your mortgage, especially if you plan on living in a house the full term of 30 years. You don't want to just make your regular payment because you're going to pay, on a $300,000, $400,000 home, you may pay back $800,000.
Now that was a gem what you just said, and I learned that in business. I don't want that to go over people's head. When I first got into the industry, working in finance, I learned that like one extra payment a year on your mortgage cuts 7 years off of your mortgage.
Absolutely.
Or 7 to 8 years.
22 and a half years.
Yeah. So that's huge if you really think about it. It's like one extra payment a year.
Absolutely.
Can really take almost a decade off. Like
basically. And it has to be towards your principal balance only. So if you're making a payment, you can't just give the bank money because they're automatically going to apply it to interest, right? Because you have to direct them where you want that money to go.
So how does that even look? So if my mortgage is $3,000, I gotta pay $6,000 if I'm doing that?
Yeah. So if your mortgage is $3,000, you can pay $6,000, and you can tell them the difference to go to principal balance only. Okay. On some online, everything's online right now with all the banks, right? So you can go pay your mortgage and you can specify there to principal balance only. You can write a check, put on a check to principal balance only. Okay. So depending on how you pay your mortgage, do that. And if it's not an online option to pay extra, call the service and lender that you're paying your mortgage to and figure out a way to accomplish that goal. Maybe they can just do automatic drafts from your account, something like that, and set it up to where you can make that extra payment. Yeah. And you'll be surprised if you make 2 payments extra a year.
That's what in my mind, I'm thinking if I make 2 extra payments now, that 7 turns into 14. Now I'm really at a 15-year mortgage.
Basically. And this is, I'm glad you brought up 15-year mortgages, right? Especially right now, folks want to go into 15-year loans. And look, the 15-year rate, the lowest I've seen it since we've been in COVID was around 2%, which is phenomenal. Crazy. Right? That's incredible. But what I try to tell people is maybe not go into that 15-year right now because life happens, right? You're committing yourself to a much higher payment. And what if, COVID-21 comes, God forbid, and is a worse strain than this? Mm-hmm. Now you're committing yourself to that higher payment just to try to pay it off early when you could have went to a 30-year, had a cheaper payment, and and manage your principal balance yourself. That way you're not committed to that 15-year term or that 20-year term. Yeah. You stay with the cheapest possible payment, but still you're paying down your debt. And I'm not against 20-year mortgages. I think for the right people, it works, right? People who have substantial income and they can really afford the payment. Yeah. But most people are trying to pay off their loan fast, which I get, but they're now cash strapped, right? They're becoming house rich and cash poor because they're making their payment so much higher because they're just focusing on, I just want to get rid of it, which again, I understand, but you got to be a little bit smarter right now because anything could happen. As we've seen, we woke up in 2020, Kobe dead, God bless, then COVID came. Like this year has been crazy. Yeah. You know what I'm saying? So like, if this doesn't teach anybody anything, you got to have cash flow right now. You got to have liquidity because anything can happen. So that's why I just try to tell future homeowners and current homeowners who are refinancing, if you don't have to go to the 15-year, just stay with the 20 or 30 years. So that way you can have a little bit more cash flow.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.